Good morning or good evening around the world. Thank you very much for joining our panel on the rise of resource nationalism that's sponsored by Fasken. And we have a truly international panel today that's going to be addressing this very current and timely issue. Thank you for coming. And I will say at the beginning that we're very grateful for the panelists who've agreed to participate, and I'll introduce them in a moment. The main purpose of this session is to really offer a roundtable amongst people who are currently dealing with the issues on the ground, to give people as much insight as to what's happening today as we can. There won't be any formal presentations, and the panelists are going to be providing their personal and not their representative views of their employer or the organization they belong to. The Q&A function is something that's going to be available during the webcast, and I'd encourage anybody who has a specific question to post it, and I'll try to feed it to the panel during the course of the presentation. We did receive 15 or 20 questions before the panel started, and I've tried to include those as much as I can in the questions which I'm going to be asking the panel to comment on. So it's very exciting, and I appreciate the panel participating. My name is Geoff Cowper, and I'm a litigator from Vancouver. Other Fasken participants include Peter Mantas from Ottawa, who is a litigator, and Karim Maalioun, who is from our energy and mining sector in London, and Michael Barassa, who's the head of our mining group in Fasken. With respect to the panelists who've kindly agreed to participate, we have Frank Kelly, who's coming in from Ottawa, who is the Director, Extractive Industries with Export Development Canada, and has extensive experience assessing and overseeing projects throughout the world. We also have Willem from Pretoria, I believe today, who is the COO for Barrick Gold for Africa and the Middle East, and he brings a wealth of experience in, as he puts it, negotiating solutions in challenging environments. David Codd is coming in from Switzerland and is a business lawyer who's had a full career in the international oil industry, working throughout Africa, the Middle East, and Eurasia. As I mentioned, Karim Maalioun is a business lawyer in our London office and is actively involved in international energy and mining projects. And then finally, as I mentioned, Peter Mantas is also on our panel, coming in from Ottawa. He has dealt in Canada with a number of politically sensitive and high-profile engagements, and internationally is involved currently in a number of challenging resource extractive arbitrations. So thank you, panel. And I'd like to start with just assessing where we're at. The topic of this panel is that we're seeing a rise of resource nationalism, and we should maybe pause and decide whether or not that's true or not. That's certainly the subject matter of a lot of headlines. But let me start with you, Frank Kelly. How would you evaluate the risk today compared with the past, and how would you evaluate if you were somebody on the ground assessing whether or not to do a project today, and what you should take into account and how you should approach it?
Thanks for that question, Geoff. So I guess let me start with maybe just responding to the evaluation of risk, and maybe break it down even a little bit more from there. So, and keeping in mind that from where I look at things, and EDC looks at things, we're looking at effectively the credit risk. But in the current environment, and if I even think back to where we were in the past, credit risk as a whole is effectively broken down into financial risk, which is becoming in some ways more straightforward in the context of effectively looking at the underlying financials that are associated with cash flow and contracts and debt service coverage ratios and debt to equity ratios, et cetera. But equally important and probably more predominant than ever before is what's deemed as the non-credit risk or the non-financial risk. And in the current environment, when we look at that from the perspective of the underlying business integrity that goes to the sponsorship behind it, an individual project, and the stakeholders that are involved across the full spectrum of a project, that is becoming a far more dimension of credit risk analysis. And then equally important and complementing that is, which you'll hear virtually on either any narrative or publication these days, is the importance of environmental social governance. And so when you apply the dynamics of environmental and social risks that are associated with projects in any jurisdiction globally, that too becomes a much more escalated dynamic of risk. And one of the ways we try to characterize that is to frame it in the context of good business is effectively good for business. And so I'll kind of leave it at that, because otherwise I'm getting into a much more deeper dialogue in the context of risk evaluation and credit risk as a whole. But I would just add that when bringing in the non-financial, the non-credit risk, that is where there's a much higher degree of scrutiny and review than I think has been in place for over the last since I started my career more than 25 years ago in this particular space. So I'll leave it there, Geoff.
Well, let me turn to Willem. Willem, my father was a geologist who used to talk about projects as being a bit like relationships. You would be looking around for someone, and then you would fall in love with either the grade or how many feet of pay there was. And then you would find out that your new relationship had a troubled family, actually had a troubled past, and had different goals for the relationship than you had. How do you evaluate those things as a business person, as you say, negotiating solutions in a challenging environment?
Let me, I'm going to talk specifically Africa. Possibly it goes to other developing countries as well, where the risk is possibly, for most people, more difficult to understand. If the geology is good, the project, let's just, for instance, say we will never build a mine in Congo for 3 million ounces. We will build it. We'll build a mine in a stable country such as the United States for 1.5 million ounces. In the Congo, we'll build one for 5 million ounces. And the reason for this is there's massive amount of infrastructure that you have to do to support. So when we look at the whole situation, we will say just three simple things. Can we convert our exploration license to an exploitation license freely, and it will? Secondly, can we get our money out of the country on a normal basis? And is it safe for them to work there, our expatriate people? Those are three very basic questions. The only way to, and the problem is that, we all went through postgraduate business education, or most of us did, and it's that concept of the beta factor. We try to put everything into mathematical concept. The issue is the way to look at risk, as far as I'm concerned, is that the only way to think about risk is partnerships. I must mitigate my risk, whatever risk it is, even if I can't put it into a number, is the only way to mitigate is through partnerships and through the relationships. And the relationships don't mean anything negative from a legal perspective. It means that I have enough relationships in order to deal with issues. Invariably, developing countries have poorly developed administrative and legal structures. So you hand carry problems through administrations rather than go to an office, submit your problem, and the system deals with it. You don't do it like that. If you do that in the Congo or in Mali, you've got a big surprise waiting for you, because your file that you drop off there will be there next year, still there. So you deal with the matter in a proper way. It goes through a proper process, but you do it on the basis of relationships. And the only way to build relationships in administrations is through absolutely keeping to the rules. I'm an absolute firm believer that the law is the law, and everything you do is according to the rules. Can I just add one more thing, and that's respect? In Africa, one big problem that the people have with regards to North American operators is that they don't show respect. Africa respect is in a different way, because you have to go there, you have to go face to face, and you have to meet. And that's where you have to put in the time in countries. Typically, I travel 240 days out of every year. I'm in the countries, at the operations, at the capitals, talking to ministers and so on. So I concentrate on exactly that. So just going back to risk, developing countries, I think you won't be able to quantify it in mathematics, but I do know, I do understand the answer, how to deal with the problem. And that's partnerships, build as many as possible, business partners locally, and relationships right through.
That's very interesting. Can I raise a related question then? I recall a minister of the Crown once telling me the first question he needed to ask was who he could dance with, like who on the dance floor could he dance with? How do you approach that question? Because every country has, if you have a project, often different people who are willing to be your dance partner and offering to help you. And some of them are helpful, and some of them are less helpful, and some of them can be risky in and of themselves. So maybe, David, I could ask you to comment on how do you evaluate the if you will, a talent in country and establish relationships in a way that have the best prospect of being successful for you. And you might want to comment on whether there's a difference in the risk as it relates to oil projects versus mining projects.
Yeah, I mean, I think currently there is. The trends are different. The oil and gas projects are subject to, I think, their own unique sort of stresses and strains. We come through a period of low oil price. We're in a climate where we're not exactly the most fashionable industry to invest in, and there's a lot of pressure on from the climate front. So I think the risks are different in the oil and gas sector. How do you? I agree absolutely 100% with what Willem said about building relationships, and throughout all my time in Africa and the Middle East, it has been the critical factor. And how do you find the partners? Well, ideally it's through people you trust. Ideally it's you don't just do a control risk search on them and review and choose them cold. You use your existing networks, and you get introductions, you build the relationship. It's not something that happens overnight. And it takes time. It takes a lot of legwork. The only other comment I'd make on the assessment of risk, of course, it differs from company to company. Every company has its own peculiar appetite for risk, particularly the above ground risks, such as resource nationalism. And it was very interesting to see that in early days in northern Iraq. Some small companies, and I was part of one of them, we went in early before people were prepared to accept that risk. The risk there was fundamentally one of resource nationalism, where the federal government was threatening the legitimacy of the whole regulatory regime of the Kurdish regional government. And then that risk diminishes over time, and more people come in when they get to their sort of accepted threshold of risk, not something that can be reduced to a mathematical equation. As you said, it is judgment. It's judgment, and appetite for risk. And we were helped in our appetite by the fact that the company was effectively the majority shareholder was a Swiss trader who was more than used to taking risk. But so the risk threshold differs from company to company.
Karim, have you seen people evaluate sort of in-country partnerships, your clients, and do you have any comments on how best to carry out that tricky exercise?
I was just listening carefully about what David and Willem were saying about the local partners. I think that we as lawyers, we are often getting questions really about whether the clients are making the right decisions in partnering with somebody on the ground, whether an individual or a local entity that will be basically the ship with 5 legs, in the country, trying actually to understand and help the mining company navigating within the arcanes of the political landscape on the ground. We've been really questioned about what type of selection process, procurement rules were to be actually provided. How could they select the local partners? What type of due diligence were they actually supposed to do? Whether or not, how could we make sure that this partner was not actually, quote to quote, the double agent working for the mining company and at the same time for the government or for other government officials? And in that regards, as David said, I think, and he smartly didn't use the word, but some reprehensible practices. So, it's all about, as Willem said. I mean, I think that not going to repeat what Willem said, but in terms of evaluation, I do believe that yes, the joint venture or the alliances with the local companies, they're critical. They enable the investors to really collaborate with the local counterpart, who possesses, a better knowledge of the local market, of the political system, and obviously the specific risk. It could also help, I think, for financing purposes, as foreign lenders, may similarly, seek, to co-finance this type of projects. Of course, it doesn't specifically go for mining companies; it goes for oil and gas and also energy projects. The second point that was mentioned, and I think without repeating it, but I think there's no magical solution here, is really the consultations with the governments and the political leaders, and obviously the good relationships with them. And this is where basically one can see whether a project is sustainable or not, in understanding actually what are the priorities of the governments and helping anticipating, the potential changes. And this is how really it can give the investors the flexibility to negotiate the terms of any new requirements affecting the investments. And sometimes, if not often, if the relationship is so good, the investors may be even able to preempt or to contribute to changes. And it's not in Africa, but one recent example that I've seen was, the Oyu Tolgoi copper project in Mongolia, where the investors, because of their excellent relationship with the government officials on the ground, they successfully negotiated with the host government for not accelerating the period of increasing the Mongolian stake in the mine. And last but not least, I don't want to really keep the word. I think, obviously, there is no success if there is no partnership with the communities. And Geoff, I mean, your question can certainly be addressed later on, perhaps, but I think that the partnership with the local communities, whether through participation agreement or other type of structures, is really something that our clients are really looking for before investing. So I can say that I've been quite impressed, honestly, by the way that our clients are showing a better understanding of how to manage and align their own challenges, such as, for example, the changing government expectations, or the government requirements for royalties and taxes and profit, share and so on, with really the challenges that are faced by the two other stakeholders who are obviously the government and the local communities.
So maybe your phrase "changing government" causes me to raise another question on this general area, and perhaps maybe turning to you, Willem, because I know you've had to deal with this. You've established a good relationship with a community. You've established a good relationship with the government. Everything is going swimmingly, and then there's political change, and the new administration comes in. Do you have any thoughts about that? I think very often the tipping point for a lot of projects is a change in administrations, which have a different expectation of the relationship, and sometimes your local relationships are less effective with a new administration.
So that is true. We try, and certainly I try, but our general approach is that we try to be ingrained in the society, which includes political society, as deep as we can. So we don't only talk to governments, we talk to opposition, we talk to upcoming political parties, and we try to be ingrained in the community. We don't pick sides, we pick democracy, and we pick the country as outlined, and we don't pick the person in power as outlined, if I make myself clear. So just recently with Felix Tshisekedi taking over in the DRC, it's already 2 years ago, we have been talking to Felix's dad, I think for the last 9 years. And although he was a no-hoper, he 11% guy, 12% in any general election, he kept on talking to all of them, Moise Katumbi, all of them. And today, it turned out well for us because Felix is the president, his son, his father died, Moise is part of the coalition, and so is quite a few of the other parties which we have been talking to as well. Not only talking, some of the people, we had active relationships with. None of those relationships were inappropriate. The one thing that you have to understand in a developing country, a successful person invariably ends up to be a wealthy businessman and a politician, because that's the spread of leadership is thin in a developing country. So it's a minefield that you're walking in, that you do not attach yourself to people through inappropriate relationships. So that's why we keep it wide. We don't make a secret of it, and it keeps you flexible. So just as a general principle, and it's a last word on it, we try to keep on reminding us that our job in the whole equation is to turn a national asset that belongs to the people, which the government is the appointed agent to look after this national asset on behalf of the people, into taxes and employment. That's our role. And for that, we're taking a portion of the money. We think a 50-50 split after loans have been repaid is a fair split. And that's our job. And as long as we can keep to that philosophically, that there's a fair distribution of benefits to the country, community, and so on, I can hold my head up very high, and I can talk to anybody in that country, because I'm as much Congolese as the next Congolese. I've never heard of any person that rents a flat apartment and pays the rent that's been kicked out of the apartment. So That's what the focus is. You must be clear where you fit in this equation. And my experience is that people are trying to finesse things too much from a tax perspective and try to do this and try to optimize tax through structures and so on. Ultimately, there's a bill to be paid, and you have to pay the fair bill, just philosophically.
So I don't want to leave this topic and leave Canada off the agenda. Peter, would you like to comment on whether the risks in Canada are rising and how our clients evaluate projects in Canada from your perspective? And I know there are other members of the firm on, and I take volunteers generally. But Peter, maybe you might volunteer some observations about Canada, and I might actually say something about British Columbia.
Sure, Geoff. Well, thanks. Canada's a different kind of country, obviously, than other parts of the world in terms of its risk. It doesn't mean there isn't risk. I think it's a very different kind of risk. You have a political and financial stability in this country that you don't find in certain areas in Latin America and Africa. You don't have perhaps the same kind of geopolitical winds blowing through the country as you may in other parts where, there may be a bit of a struggle between the United States and China, and I'm sure we'll talk a little bit more about that later. But you still have risk. You have, for example, you have to deal with Indigenous communities, First Nations communities, which, increasingly are very concerned about making sure that they get a fair deal, and also making sure that the lands upon which they live, are not adversely affected from an environmental perspective. And those are, those are significant things in this country right now. Most people, one of the big global headlines the past few weeks has been involving the Indigenous communities of this country. And, that is going to have an impact on this government, has had an impact on this government, and how it responds to First Nations. And, that's going to affect companies that are in the extraction space. I think there has been a lot of evolution over the last few years as to how things are dealt with in this country and in that space. I think you're probably going to see a lot more. And it also depends on the current government. I mean, Willem was just talking about governments. Just the way you see in Africa, governments will change, and that has an impact. Obviously, the current government, which is much more concerned about climate change and the rights of Indigenous people than perhaps another government. If they're around for a while, that's going to be something any extractive industry is going to have to be careful about. But, back to Willem's point, though, just the way it is in every other country, countries have got interests, and, they tend to be about, making sure there's a good revenue stream and there's fair deals out there, and they want stability. They don't want, people protesting and whether you're an authoritarian government or a democracy, you don't like instability in your country. You want a certain stature, both domestically and internationally. Those are things that, always are at play. And I think any smart mining company is alert to those things and make sure that they're part of the solution, not part of the problem. Once you become part of the problem, you're on the wrong side of the ledger.
Yeah, I think from a Canadian perspective, my observation, which is from a British Columbia perspective, for those who are listening, of course, in a federal country, you have to look at not only the risk that is a country risk, but you also have to look at the subnational risk in a case where in Canada, the provinces have a great deal to say about how resources are realized. And Canadian mining companies have had the experience of some jurisdictions like Quebec becoming a very open and willing partner, and then changes in the environment making it a more difficult one, and then vice versa. I think that the main thing I would point out right now is that everything I think Willem has said actually has its application in the Canadian environment. That the idea that you could just walk into a project and just get a mining permit and read the Mining Act and know what your rights are has faded. And mining executives in Canada need to know who it is they need to have relationships with, as you would in any other part of the world. Which Indigenous group has a stake, a particular interest in your resource, and how are they interested in developing things? I think there's a huge hunger in 2021 compared to 5 years ago in the First Nations to be collaborative and contributive partners to resource development. You're seeing that changing under our feet, where Indigenous populations and Indigenous leadership is saying we want to be part of development. We want our people to have jobs. We want our people to have future. We have a stake in the resource industry that we want to see positive, but it's not even, and it depends upon leadership as well as views. I think that's shifting under our feet, and I think you can see that with partnerships being announced and being negotiated with First Nations. British Columbia has the challenging fact that we don't have treaties in place. Most of Canada has treaties in place which make the environment a little bit more predictable, but I think it's still the case that Indigenous First Nations have to be approached with the same regard that you would have for communities in other countries. Peter, what I'd actually shift to a little bit is, what do people see about the rise of ESG generally, but also the concern of environmental groups for resource development? And is that on what's the smartest approach to that? In Canada, there's clearly some environmental groups who are opposed to development or some developments on any terms. And there are also environmentalists who recognize that there are some projects which are net contributors to human welfare and should proceed. But what's your experience in terms of dealing with the environmental input on resource extractive industries, and what are the most productive ways of dealing with it? Maybe Frank, do you have any thoughts on that?
Yeah, yeah, sure do. I think the interesting dynamic around that is, as we've already been talking about, is the continued cultivation of partnerships and inclusive involvement. Certainly, as we see, and leverage things like free, prior, and informed consent is an important dynamic. I think the key component, though, is, and again, jurisdictionally, you can be discussing something about in Canada, you can be discussing something in Africa, the Middle East, Asia, South America, but to have that involvement by local stakeholders, again, and sort of circle back on what Willem just said, keeping it very, yes, relationships are important, but there has to be an autonomous nature to it as well, in the context that it is independent and it is adherent to rule of law, etc. And so those are all key dynamics. But going back to one of my original comments, I characterize, and I agree with everything that was been said for the last 20 minutes or so. But it's this dynamic then that forms part of that non-financial, non-credit risk. But at the end of the day, if it causes a disruption with regards to the underlying economics associated with any project, then it's an inordinate risk that has to be addressed. So it's a topic I could go on for forever, but I think I'll leave it there. And I see David has something to add to that as well.
Yeah, I mean, it's interesting because somebody mentioned home country risks as well. Oil and gas is clearly in the crosshairs of environmentalists, and there are many out there who wish to sunset the industry sooner rather than later. And I was reading with considerable interest some of the heat and criticism that Recon Africa has been getting in Canada. And they were, would appear to be remarkably successful at this stage of their Namibian sort of operations, and but they're getting heat from home, as it were, from groups who would rather no more oil and gas assets developed who want to leave them stranded. And this threat of stranded assets is a massive overhang, I think, in the oil and gas sector. But I read with interest the Canadian company getting probably more grief from its home country than from the host country.
Well, it's a national concern in Canada with the oil sands, as you talk about perhaps one of the highest international risks of stranded assets being oil sands, and we haven't yet come up with a solution to that for sure. Willem, what's your comment about the overhang between, or the overlap between, home country risk arising out of concerns for honest participation around the world and environmental concerns arising from the home country of a company or home, an at-home risk, as David would say, as it relates to activity in developing countries or elsewhere? Is that on the rise? Is there best practice in dealing with it, or is it just we're all learning as we go? Did you hear that question, Will? I'm sorry, you're on mute. That's the first time you've had to say that in this panel. Again?
Sorry, Geoff, I lost you.
That's okay. What's your response to the overlap between governmental risk and environmental concerns that come out of either the home country or the local community?
Yeah, funnily enough, well, first of all, the whole environmental mantra, which is now being spoken about as if the people discovered it yesterday, has been part of our way of doing business long before it became really fashionable. That is complete involvement by communities and everything to do with the environment. We've been reducing carbon gases long before it was fashionable. I built personally 3 hydro stations in the DRC. I've got microgrids in every mine. So in many ways, it's like deja vu for me when last year, all of a sudden it burst on the scene. So the funny part is that right through the developing country, environmental standards as converged. It's roughly the same right through the world now. The issue in the developing world is that the ability to actually police it is not there. So you've got very sophisticated legislation, very sophisticated standards, but then the ability of the government to actually deal with sophisticated legislation is simply not there. And that's the issue in the developing world. I can say to you, we've got the same legislation in the DRC, Tanzania, and so on, that what we have in our mines in Canada, bar 1 or 2 small things: cyanide standards, lead standards, the whole lot. So when you say the overlap, I think government must do his job, do the legislation, proper legislation, then create an ability to police it, and by the way, mining companies and oil and gas companies are really trying to forge ahead. Just going back to David's point, I've been involved in oil and gas companies for a long time. My experience of oil and gas companies is that the awareness, the environmental awareness of oil and gas companies has gone up 100% over the last 10 years. If I just look at how they tackled the pipeline, Total tackled the pipeline from Uganda, Victoria Lake to Dar es Salaam. I mean, the amount of consultation that they've done with every village and so on is just amazing. So David, I think there's been a huge change in oil and gas. I think what we've done in the developing world in mining, I think you guys in Canada and so on is only starting to discover, because the community has always been part of the mine in the developing world. So you guys are starting to discover it.
So I noticed from our participants, people have asked about South American risks, and particularly Peru and Chile. So I want to respect that question. I know that most of the experience on the panel deals with, other parts of the world. But does anybody have any comments? Really, in Peru and Chile, you're seeing constitutional changes, or really quite significant changes of approach between administrations. Do you have any comment on changes in administration which go, against any foreign investment, or seek constitutional changes which might affect your project? Frank, do you have any thoughts about South America as a distinctive region and what you're seeing happen in some of the countries like Chile, Peru, Bolivia?
Yeah, I mean, historically, EDC's had some very positive experiences in South America, and currently we have meaningful exposure in all those countries, in Chile, in Peru, in Colombia, Brazil. But I think, and I'll kind of leave this more to the economists and the political analysts, but for the most part, there's a couple things that was already mentioned. I mean, the importance of the underlying investment agreements and the integrity of the stability that's associated with those investment agreements. At this stage, I would say we're not receiving any indications that those positions are in jeopardy. We are closely monitoring the situation. For the most part, again, it comes back to, in the context of new investment, the thoroughness of the analysis and the thoroughness of making those those financial investment decisions to move forward. But clearly there is there's a social undercurrent that is taking place, and again, it behooves the sponsors to be very conscious, again, on coming back again to the ESG component of how they're engaging with all key stakeholders, not only the government representatives, but the social representatives as well, that are effectively looking at some sort of dynamic of change, whether that's through a negotiation with the ruling governments, or through new political transitions and whatnot that are taking place. So it's a big topic, but I'll leave it there for the time being.
Yeah, maybe I'll pull out a legal question here, because Peter, we're seeing across in various countries around the world terminations of bilateral investment treaties or multilateral investment treaties, and changes in administrative rules for existing projects. Could you just comment for the participants on the significance of grandfather provisions in bilateral investment treaties, and how you see that occurring in terms of when a government goes hard against an existing project, how their termination of an investment treaty might affect their rights?
Yeah, well, Geoff, it'll depend on a nation-by-nation basis, of course, but typically a lot of these bilateral investment treaties will have a sunset provision or some kind of grandfather clause where they continue even though they've been terminated. And, I'm involved in several of those right now. So, if you are faced with it as a company, obviously make sure that you get good advice and assess your position on that. There does seem to be a trend towards these types of things happening, which is interesting. It seems to signal a shift in the thinking among nation states. I don't have any hard analysis to be able to say which ones have stopped, which ones are going over the last few years, but there does seem to be a shift towards more of a away from them and a different approach. Hard to say why that's happening. Probably aligning with just a general rise of nationalism across the world. That could be part of it. I think in certain countries, I think there's a sense that there may be a need to realign with other countries, maybe a move away from the United States and towards China, something I think that, again, we'll want to talk a little bit more about. But there's definitely some unique winds that are blowing right now across the world, which I think are affecting that trend. Critical minerals are another thing as well. We're seeing a shift in the mining sector generally towards minerals which are perceived as fueling the economy of the future. Be it things that go into batteries for electric cars, or things that will fuel the continuing rise of communications and how that underlies our entire global economy, and how it allowed us to be able to do this, or to survive a pandemic as a world economy without completely collapsing. I think those are the things that are kind of affecting how countries view how they should deal with BITs and other forms of protection for investors.
So I think a couple of comments that I might make from my perspective, which is we are seeing the leadership in this area was provided in the post-World War II period overwhelmingly by the United States, which insisted on bilateral investment treaties, and in the latter part of those generations insisted on independent adjudication of claims, and eventually through NAFTA and other treaties allowed companies to have direct access to arbitral relief. And of course, that has resulted in a very substantial number of awards against countries. Canada, I think, is on the losing end of this. We've lost a number of awards, but developing countries very often felt that it was the cost of participation in the broader capital markets. And they felt through leadership of American institutions, the World Bank and others, that they had to essentially give on independent investment guarantees and adjudication to participate. With the dropping away of those provisions in the new NAFTA, I think there is a sense in which the Americans are no longer as fond of those provisions as they were. There's a shift of leadership internationally. And so I think that is contributing to these terminations. From a practical project perspective, if you have a project, there's almost no bilateral investment treaty that isn't going to include coverage. In a practical sense, what that might mean, though, is the chances of negotiating a settlement with the host country may have gone very, very low, simply because their plan is to leave that environment behind them. And so it's a very, very unclear situation right now in internationally. From a legal perspective, you're likely to retain your rights, but the threat of those rights may not change the behavior in the country that's determined to turn away from them. And it's obviously a country by country evaluation. Let me ask, because I think one of our questions that came from the panel was the overall role of China in this, and I will leave it up to people to comment. China has certainly sought to pursue relationships in Africa and other developing countries in a model that is not the Western liberal democratic model. Willem, what's your perspective on the Chinese question in terms of are they winning in that respect, or is it too early to say, like somebody says about the French Revolution, that it's just too early to know whether it was successful or not? And how do mining project folks assess the changes and risks represented by China's foreign policy?
Just to answer your question, I think I must take one example. In about 2010, 2011, China gave $8 billion to the DRC and for infrastructural development. That $8 billion was a loan, and the loan had to be repaid by means of concessions or mines, not mines, but concessions given to them, which they will record, and over time that $8 billion will be repaid through metal being processed and exported to China. In the process, China has dug itself into almost a position where nobody can beat them in copper and in cobalt. Only one that's between them and complete whitewash is Glencore. So they've converted a loan into a long-term position, right? And on top of that, the companies that they brought in don't pay corporate taxes, don't pay VAT, nothing. So their contribution to the local economy is zero. All of them were protected under the bilateral trade agreement between China and the DRC. So does China win in the DRC? China absolutely is winning, but DRC is starting to push against that. Tanzania is pushing against. Remember, China is a very old partner of Tanzania. In the Cold War, they built the railway line from Dar es Salaam to Angola and so on. So it's an old partner. But even Tanzania has resisted China now. So do they win? I think they win in specific places, such as DRC. They may be losing fields, losing position in other places. They most certainly is not conducting business with the same emphasis on environment and community like you and me. In Zambia, for instance, when they took over Chimbisi, they brought almost everybody working in Chimbisi as Chinese. So the local community doesn't get employment, nothing. So, and Africa is starting to wake up to that reality. How do they deal with it politically is another matter, because Zambia is completely beholden to China on loans. So there's a massive lever. DRC, the same. Tanzania, some loans. Kenya is completely leveraged against China. They're massively in debt with China. So over time, that's where China got themselves into, where they're a banker, and they've got bilateral trade agreements and their own assets as a collateral against the money that they've given. By the way, which America has never done, Canada has never done. They never claimed assets in countries. You only went on a piece of paper, which is a bilateral trade agreement. So the methodology that China is working is very different to Canada and America. Whether there is a bilateral trade agreement or not, they have the asset.
So let me shift talk. Oh, sorry. Go ahead, David.
Sorry, just a postscript to that as well, and they are not afraid of using their considerable sort of political muscle as well. There was a very recent case in Nigeria where, for various reasons, the regulator wanted to withdraw the licenses from a subsidiary of Sinopec. It announced its decision, and it was going to reissue them to a local company. So a classic case of resource nationalism, not particularly benign one. They weren't even talking about compensation. But it didn't take long for the Chinese government to put pressure on the president and have that decision revoked, notwithstanding the concerns that some of them quite legitimate about the way that the assets have been operated. So it's not afraid of using its muscle. And in that case, resource nationalism came a cropper head on with the geopolitics of Chinese power.
Yeah. I'm sorry.
Go ahead, Karim.
Karim, let's go to Karim next.
On DRC, and again, I'm really speaking under Willem's control here and comments. We've seen eventually the president Felix Tshisekedi recently, a month ago or so, saying basically that all of the contracts with Chinese miners in DRC will be completely renegotiated.
Correct.
And this is mainly because it has been actually shown that, as you said, there were no redistribution, whether from tax standpoint, whether from a local community standpoint, and so on and so forth. We also understood basically that this request, although obviously propelled by the president, was also driven by the willingness of the IMF and the World Bank to see all of these contracts being transparently published and communicated so that everybody understands, what are the rights, obligations, and duties of each and every stakeholders. My question, and I don't want to play a Geoff substitute here, but my question to Willem is, do you think that these contracts will be renegotiated? And I'm asking the question because, as we may know, or people may know, the consortium who has been also selected for the Inga project, which is, as we know, an 11 gigawatt mega dam power project, is Chinese. So I don't want to do politics, but I just want to understand from a business and practical standpoint, Willem, whether you believe that this public announce will be followed by concrete actions.
I do believe so, but at the same time, about a week after that announcement, the Chinese ambassador arrived, and he's very close to number 2 in the universe, and nothing concrete has happened. What I do know is the calculations that the Minister of Mines office has made. It's very clear. Your 8 billion has been repaid, and they want to draw a line through that 8 billion because that loan can be called on. So the one objective is to get that 8 billion to take a line through that. That's the first objective. Second objective, they need to convert those Chinese mines, at least to an extent, into contributing to the DRC economy through taxes. Whether it's fully possible or not, as remains to be seen, but they're going to have a real go. China, whether they're going to put pressure on, I can absolutely guarantee you that. I've been in the 1918 mining code negotiation. I was right in the middle of it since 2016. We were driving it. And I can tell you, every time when we get to an answer, the Chinese ambassador arrived and he took the Chinese company out of the equation, not part of the mining code. So when the 2018 code was announced, everybody was in except the Chinese companies. So I'm absolutely sure China is going to use their muscle to the fullest extent. I'm very sure of that. And it's considerable. Sure. And as David pointed out, they're not afraid to use it.
Geoff, I know you're anxious to move on from China, but I want to pick up from Willem. I think the China point is the biggest one facing mining companies over the next few years. And I don't say that from a negative or a positive perspective. I'm just saying I think that will be the biggest factor over the coming years. And I say that because while clearly for those of us who do any work in this area, I've been seeing the rise of China over a period of time over the last quite a few years, to the point where they are a major player in this industry globally. What we haven't seen in the last few years, I would say, is what happened in the last 2 weeks, where you had a president of the United States coming out and drawing a line in the sand effectively at a NATO meeting and saying, we're going to take a stand against China, and in talking about human rights and talking about how there needs to be sort of a new alliance of democracies to deal with, China. And again, I'm not here to, make any value judgments. Just as an observer, you need to look at that and you need to say to yourself, okay, what does that mean? We know that for China, securing critical resources for to maintain its economy and to continue to exert its global influence is important. I don't think anybody's going to doubt that, and good for them for doing it. We know that over the last few years, the Trump presidency has taken a more inward-looking approach to how it deals with things. I don't think anybody who does this kind of business, I don't think anybody could seriously doubt that. We have a different paradigm starting to arise, and thinkers are talking about how we're perhaps heading back towards some kind of bipolar world. Resources are on the front line of that battle, and you're going to see it in Africa. You're going to see it in Latin America, where the Chinese are going to start rubbing against U.S. interest and perhaps European interests and others. And I think it is going to have a huge impact on the question of nationalism. And I think you're going to see also the Chinese starting to withdraw from certain countries, disengage. For example, you see it with Australia. And I think you're going to start seeing a renewed and focused engagement in countries that look like them, that are authoritarian, that have similar types of governments. And they're going to do what Willem just talked about. They're going to do it their own way. They may view it as being smart business. We may view it as not being smart. It's going to be different. And I think people need to hold on tight for the change in this area, look for the opportunities, figure out how they deal with it. That's just my prediction over the next few years.
Well, I'm glad it's a good panel for predictions. I would reflect back on a larger historical perspective. And of course, David, the United States has been regarded as a very assertive power in relation to resource development in the past. And, the WikiLeaks disclosures certainly showed that American diplomatic efforts were exercised regularly in support of American investments abroad. And ultimately, these things were heavily influenced by politics starting back at the Industrial Revolution. And the politics has changed, but the fact that politics affects these things isn't anything new. We may be entering a new struggle between different models of development. And, Peter, if China ends up concentrating its efforts in countries that are, as you've described, a subset of international countries, and we're fighting as international diplomacy always has been between allies and neutrals and opponents. And it'll be interesting to see how that plays itself out. So it is definitely too early to say how that plays itself out. But at the same time, the new administration in the United States clearly is reverting to a more if you will, thoughtful, but actually an extension of some of the Trump administration's policies in relation to China. It's interesting how similar their approach to China is as opposed to how different it was at the time. So your point was stay tuned, put on your seatbelts, and for project people involved, it's now going to be a very important part of success. Let me ask, if I may, just switching a little bit, and this is really a tough question, so I'm not expecting a gold medal answer, but what is the right threshold for someone assessing the purchase of an asset or the development of a project? What's the right threshold for go, no go? Do you have any thoughts for our participants about, on a project-specific basis, what do you think people should be looking at, and the relationship between what I started this with, the relationship between grade and risk? I think, Willem, you talked about a very practical, how many tons of mineral are you willing to develop in a given country? David, do you have any thoughts on the oil and gas experience you have on a go, no go threshold? And then maybe back to Willem for any further thoughts he has.
Yeah, I mean, go, no go, very, very personal to the organization. Obviously, the smaller the organization, the smaller the corporate, the issue of what can you afford to lose. At the end of the day, you're putting part of the company's balance sheet at risk. You assess what the level of that risk is, and if it's not a particularly significant part of your balance sheet, then you might be able to you'll have an appetite to gamble maybe a little bit more, and that certainly was the case in one of my prior lives. where we took a considerable risk being first mover into Kurdistan, and it paid off. And an awful lot of companies weren't prepared to do that, the smaller independents. So it's it's not black and white. I mean, the go no go depends upon an assessment of risk which can't be reduced to a spreadsheet, and it's the level of your financial exposure and how critical that is to you. So it's a complex matrix and not a simple answer.
Maybe before going to Willem, Frank, do you have any thoughts about resolving all this general discussion into the factors that should go into go no go?
Well, as David just said, I mean the financial investment decision and taking a go or no go view around that does come down to the risk appetite of the individual investor. I mean, I think I'll take a step back a little bit as a senior lender. Obviously, this is one of the linchpin dynamics when we're giving consideration to accompanying that investor in the context of joining them as a senior lender in the overall capital structure. So clearly the decision points that go into such a decision are not taken easily, and in many cases they happen over years of assessment and evaluation before a final determination is set. So I think I'll leave it more for the investment side of the equation, both with Willem and David. But those are just a couple of observations from a lender's perspective.
Just to pick up with after David and Frank, we must just remember from the day of discovery until the day that a mine is ramped up, it's probably a decade. So, and it's very important to keep that in mind. The same goes for an oil field, the same goes for a gas field. It's a long time. In that period where you decide to do exploration, you're very excited about what you find, to the point where you have to make a decision to spend $2 billion, is a decade. And it can be 2 presidents, it can be a new world order change, it can be many things. So you can get to a point where you are committed, right? You've got a fantastic resource and you have to make a decision. So don't lose that out of our discussion. You are, in terms of how you project your corporation forward, remember you had 4 road trips a year to investors for the last decade, and you've been telling them about this asset of yours which is in development. So this has been part of your story now for 10 years. And your share price reflects some of this glimmering future value that's coming out. So don't forget the emotional investment that you've done over the last 10 years. On top of that, after I've said that, I really want to look at this kind of a go no go situation. There's not one way to deal with your risk. We've done in Randgold, just before we merged with Barrick, we've done it twice. Where in the DRC, where we thought the risk at that stage in 2008, just after the Civil War, was very high, and we sold 50% of the project. We sold it to AngloGold Ashanti. So we had, at that stage, AngloGold Ashanti was a much stronger company than us. Therefore, we halved the risk. We were operators, we remained operators, and we sold it. So now you've strengthened yourself. Yes, you've taken 50% of the earnings out, but you've got the asset. Remember, asset is there for 30 years. Lots of things can happen in 30 years. So one way to deal with your risk, therefore, is joint venturing, innovative ways of bringing people in with a stronger balance sheet than you to help you alleviate the risk. I think the most important thing for me to understand is that we in resources are in this for the longer term, and that you have to understand. None of our decisions is about developing an office block downtown, which you do in 12 months or in 14 months. All of us are in this game where you do investments for 20 and 30 years. That means that you have to philosophically accept that in your decision and in your deliberation, you have to allow for lots of things that can happen. And you must take broad views of where this thing is going to go over time. And that is, I think, the biggest difference between our industry, extractives, and any other industry. We are investing over the longer term, always over the longer term, where almost every other investment can be turned into cash in the short term, and the investment horizon is 2 years or 2.5 years. That's the difference. So you have to be philosophically attuned to the environment, and you must be able to say, these are the 5 variables that I have to watch into the future, and you must try to deal with those 5 variables on an ongoing basis.
David, how do you manage that in a declining industry which people see as a sunset industry, namely the oil business? If you're looking long term and you're looking at a project, how do you fold that into your thinking when lots of people are hoping that the oil industry doesn't have a long-term future? I think they're sort of living out Keynes's observation: in the long term, we're all dead. So how do you deal with that in the oil context?
Well, I mean, firstly, I mean, you either believe there's going to be a market for your product, and if you don't, then you get out. And so if you believe that in your projections as to market and price that underpin any project decision, that's what you're betting on. The most important thing is to invest in an environment where you think you will be able to actually produce. And so, most of the countries we're looking at, they are not wholly dependent. They're very largely dependent upon oil and gas revenues. They want you. They still want you there. And they're desperate to attract limited, the decreasing sort of appetite for Western inward investment. So I think at the end of the day, if you don't believe in the product, you shouldn't be in the industry. And if you've got a host government that is offering you terms enough attractive enough to compensate for the risks you're taking, above ground and below ground risks, then you go ahead, and you go ahead and try and manage them on an ongoing basis, just as Willem was saying. And then you do your best, but you can't. As an independent oil and gas company, you can do very little about the macro situation at the UN climate change level. Some of the more aggressive predictions may be correct, may not be correct. You've got to take your own view on that. And if you believe there's a future for your product, then just go ahead.
I think economists would talk about the elasticity of supply, and I think it varies, right? David, I think historically, oil has actually had a very high elasticity of supply in a very aggressively increasing demand environment for a century. It's sort of overlooked. The fact is, supplies have actually responded to demand pretty effectively for 150 years now. In certain metals, that's not been the case, and the delay that you've talked about, Willem, or the planning cycle going up to 10 years has a direct economic impact on the price of competitives, and the responsiveness to increased price can be delayed, and thereby you can make money. Copper has seemingly hovered above its marginal cost of production now for a number of years, even when it's had its variations. So what I think we should probably, and I'll invite people to send. I've had a couple of questions during the session, but people should send along any other questions, and I'll try to pop it in. But maybe in the last few minutes, we can turn to two questions. And I'm going to start with the question of, when do you cut and run? I think that's one question we haven't asked ourselves. And then once you've decided to run, I'm going to turn it over to Peter and others to talk about how do you manage disputes in trying to make the best of what you've left behind. So I put it colorfully, but there does come a time when you have to decide whether to cut and run. Do you have any thoughts about when that decision and how that decision has to be made, Willem, from your perspective? What are the key factors that you should take into account there?
I think, fortunately, I've never been forced to cut and run, but I think in the case of oil and gas and mining, sorry for these noises in the background, it's my dog in the study. But in the case of oil and gas and mining, it's very hard to make that decision. The moment you've got that hole in the ground, the cost is sunk. And to be honest, if you look at it from an accounting point of view, you can go to variable costing, and you can just start to argue variable costing. The moment our people is endangered, we're out of there. If we can't move our country out of our money out of the country, we're out of there. And the moment there's a physical danger of any sort, we're out of there. So as long as I can maintain that, I can do many things from an accounting perspective and many things from an operational perspective to cut fixed costs, to cut any. I mean, I can go low in all my mines. So that's why, Geoff, when we spoke about a few days ago, that's why grade is so important. When you're really in trouble, you call on grade. Because grade bails you out of almost every problem. So that's why we as a principle, we focus on world-class resources. In our very difficult jurisdictions, we will only do that. Why? If you're in trouble, you do great, and that bails you out in most cases.
Grade and feet of pay, I guess, David, would be the equivalent in oil.
Yeah, grade and backbone.
Karim, what's your view on what are the non-negotiables? Are there anything other than Willem talked about safety, ability to export, receive profits? Are there any others you'd look to clients to say, hold it a second, this may be time to cut and run?
Yes, I mean, I think that we haven't discussed about this, but I'm sure, and I'm surprised that the audience has not yet raised any questions about that, but what we would call actually the reprehensible practices or behaviors on the ground, or attempts to act, I would say, on a non-compliant manner. I mean, we've been facing, as Fasken, certain demands, certain requests for advice as regard the situation where there has been some attempts to basically, influence certain behaviors in order actually to get or to maintain the conditions of the business on the ground. I think the situation is different when we're talking about cut and run as to whether we are on the project development side versus on an operational side. I think, it would be easier. I mean, it should be easier to cut and run when this behaviors or this, I would say, health and safety threats happen when you don't have any assets, physical assets really operating on the ground. But the problem is obviously when you have an operational mine and that this type of, I would say, constraints are really happening. And this is basically, as Willem said, and David and Frank as well, I think that the world-class behaviors and the compliance guides, but also the internal policies that should be and must be very, very accurately drafted with a lot of trainings, stakeholders within the organization, but also surrounding this organization, should work. And as soon as you basically, I would say, cut the discussion by simply making sure that there's not going to be any deviation on our policies and that we're going to stand firm, I think that people are not coming and people, are not attempting anymore because they know you. And also they know that you are contributing to the economies of and to the economy of the country by not only paying taxes, but also contributing to the well-being of the communities through participation agreement, through market-based solutions, through improvement policies, including recently what we've seen in Madagascar in particular is the situation where certain miners have been collaborating in granting certain healthcare services. I don't know, I've heard that there was some vaccines that were actually imported, with the help of certain miners, in Madagascar. But long story short, yes, obviously we're getting a lot of requests in that sense. And I'm sorry I had to mention this because it would not have been a complete discussion if one never brought this topic today.
So I have a question on the panel that just goes back a step, but let's honor our audience. And I'm going to come back. And the question was, and is what percentage of NPV is right for a particular project? Because it varies from, below 50% to a much higher percentage depending on the jurisdictions. And I mean by that the allocation between the mining company and one or more variations of government revenue. What's your view about that? And how much, I'll ask the follow-up question, which is how much of that is dependent upon current prices, and are there ways of dealing with rises and falls of prices which have been proven to work? Because we're dealing with, when rising prices happen, often governments feel like their share wasn't well negotiated and should be increased. That's a reality in the life of many projects in the developing world. Willem, what's your thought about that? And maybe to Frank.
We've been involved in the majority of mine formulation in Africa. We've modeled probably about 90% of all mining tax codes in the world. In the developing world, anything between 45 to the investor to about 52, 53 to the investor after loans has been repaid is about the norm. The moment you drop below 40, it becomes low. So we negotiate. We try to model all the mining codes that we negotiate, that we stay as close as possible around the 50-50 division. And we don't get it always right because it depends on the commodity price. It depends on accelerated depreciation, when, how, and so on and so on. But it's there or thereabouts.
Frank, do you have any thoughts from a underwriting perspective? What you see happening and what you would expect?
Yeah, I mean, it's an interesting dynamic from the perspective that as a lender, we want to ensure that the investor is yielding a return that is meeting their thresholds, their investment thresholds, and at the same time, though, as we've been chatting about in the context of resource nationalism as a whole, it's equally important, and Willem just touched on this as well, that the host country is also is receiving what they believe to be fair compensation as well, and it goes back to the fundamentals of the investment agreement, or stability agreement, or whatever terminology you want to apply, to ensure that is in play. As a lender, I mean, the last thing that we want to see is a disincentivized investor. That's just simply bad news from the perspective of a senior lender. And again, our our lens is largely focused on overall stability. And, when we talk about some of these projects, and the discussion around cut and run is an interesting one. And I it kind of, what came to mind was sort of the decision point where those things actually arrive on. And it's a different, albeit there's significant amounts of capital that's at risk from the investor, but making that decision pre-financial investment decision versus post carries a lot of influence as well. And, again, as a lender, in many cases, and I shouldn't say many, in some situations that we've been involved with, the bottom line is actually bringing everybody back to the table to conduct a renegotiation, and then determine what is in fact the equitable economics for all the key stakeholders that may be involved, and that could be, as I said, include host country involvement as well.
You're back
So
to
we're coming toward. Sorry, Willem, go ahead.
I say he's back to relationships, and then Frank, I think that's the most important thing. When we negotiate mining conventions and so on with governments, they model with us. So their financial people model with us. It is transparent, and in the case like Tanzania, we've got an annual true-up, where their team sit with us to do a true-up, that to make sure that we get to 50-50. So if we are getting more than 50 economic benefit for the year, we pay more tax because the agreement is 50-50. So working with the host government on an ongoing basis is, as far as I'm concerned, is key. Transparently, openly. And you don't always get it right. There are fights and so on, but that's life. It's a little bit like a marriage. You have to make it work in the end.
So let's talk about fighting as our final topic as we wrap up our time. Peter, you're the boxer in this particular fight. What trends are you seeing in situations where the relationship hasn't worked and you're trying to obtain compensation? What do you see in the international field as the main trends happening right now?
Well, Geoff, maybe, and I'm sorry to do this to you, but maybe I can just loop that question with what Frank and Willem just said, which is about maintaining relationships. Because, often people associate litigation with just all-out war. And sometimes it is. And, I've had my fair share of those cases. But, as a litigator sitting on a panel where we're talking about, global political shifts and mining, I mean, it's because you need to be ready to try to maintain the relationship. And, we talked about cut and run. Most of my experience has been that, it's sort of a run and then think about whether you have to cut. Sometimes you do have to cut. So, I mean, if it's an outright expropriation, you got a problem. But often it's something in between. And if you're a smaller mining company, I think you tend to see that a lot more, where you're really trying to work in difficult environments. And typically, a lot of mining companies are in very complex, difficult environments. And if you have a dispute, part of it is, you have to litigate. Really, anytime you litigate, you got to also be ready to make peace. Willem talked about his well-behaved dog there in a minute ago. A lot of people sort of want to go out and get themselves a pit bull that bites into the leg and doesn't let go and pays lots of money to the lawyers. I mean, that's not necessarily what you want to be doing in this industry. By all means, if you have to do it, do it. But so much of it is knowing when to pivot and to try to resuscitate the relationship and perhaps bring in more stakeholders, figure out how you're going to deal with the myriad of relationships you have. I mean, it's not just your relationship with the government; it's also your relationship with locals and suppliers. I mean, or international suppliers. It can get very, very complex, and that's what I think you want to be doing. And as times change, you want to figure out, okay, who are the new stakeholders I need to worry about? What else do I need to worry about as I'm trying to navigate disputes within the country, which often will happen.
So I think we're almost up at the end of our time, and I want to thank all the panelists. That was provocative and challenging and real, and I hope everybody enjoyed those observations. And I invite anybody who's listening to follow up with any of the panelists or the firm generally with respect to specific advice or specific questions. We're happy to respond to those. And I think earlier somebody said, stay tuned and put on your seatbelt. And I think that's an appropriate way to end the session. Thank you very much, everybody. And with that, we'll wish you the best of the rest of your evenings, mornings, or afternoons, depending on what time zone you're calling in from.